Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
It is Bloomberg Business Week Daily. I'm Tim Stenivek, along with Isabel Lee from the Bloomberg News cross-asset team. Carol Massar is out today, and it is a data-heavy week. Right now, if we look at the S&P 500, we're down just about, just shy of 0.2%. The NASDAQ down about the same. The Dow down 0.5 percentage point. As far as earnings go, we're pretty much... We got Nvidia at the end of this month, but we've made it through quite a few of the companies in the S&P 500. July inflation data we're getting tomorrow. The CPI is what I'm referring to. We're going to get PPI on Thursday, retail sales on Friday, industrial production, some sentiment data from the University of Michigan as well. Watching it all is Molly Smith. She's Bloomberg News economics editor. She joins us here in the Bloomberg Interactive Brokers studio. Did I forget anything?
Those are the big ones. I think
those are the big ones. What's the most important? CPI tomorrow?
Oh, yeah. Hands down. So that's the biggie. That will be
Not if you're the Fed, though. You don't care about CPI, right?
Oh, well, they do. I mean, it's not, of course, their preferred inflation measure. That's called the PCE, the Personal Consumptions Expenditures Price Index. It's a lot lengthier to pronounce, but they prefer the PCE. But the thing is, PCE draws a lot from CPI. So we do care what that has to say, as well as what PPI has to say, which also feeds into the PCE. And I think that should do it on acronyms for now.
We'll get to more, don't worry.
But at least for that sentence. But yeah, the CPI tomorrow. So that's going to be for the July inflation data. And it looks like we're going to see what economists are expecting more signs of tariff pass through in some of those key goods categories, as well as some pickup in services costs. So it's going to seem probably a bit broad from what people are expecting so far. So that's going to for us, of course, we're looking at the goods categories because we want to know what's happening with tariffs, and that's what they mostly apply to. But to see that services costs are picking up again as well, that would be just really bad news for the Fed to see that this is really not just a tariff story if broader inflation is picking up.
So based on your reporting, how much of tariff is really motivating inflation?
So it's been, I think we got the clearest sign in the June CPI, which that didn't affect the headline number so much, but when we looked at some of those key goods categories of, goods that are commonly imported, like toys and appliances and electronics, that those were, noticeably firmer in June. And that's what we're looking for in this report as well as some other goods categories to flag also. So that's where, it's been a little bit tricky then to decide how much are tariffs really impacting inflation. Is it just going to be in some of these goods categories, but you have these other dynamics that are keeping overall inflation in check? How much of that does that we want to, of course, look at inflation as a whole for the Fed's perspective, but they also want to know how persistent any of this is going to be and how broad the impacts will be.
Well, Jay Powell has talked about it being a one-time hit and inflationary in the sense of, yes, it'll happen one time, but then you won't necessarily see the sustained price increases year after year from tariffs. Is that generally what economists believe too?
I think there's still a bit of a split opinion about how this is going to happen because there hasn't really been consistency as to how companies are responding with their pricing strategies. And a lot of them have been trying to hold off on raising prices so far because there's been so many reversals and pauses and on again, off again with the tariffs. And, of course, for the most part, the big ones went into effect, just at the end of July on when he set those reciprocal tariff rates. But we still have, perhaps there's going to be a truce now with China extended for another 3 months. And a lot of these companies are sitting here looking at their pricing strategies and they don't want to, antagonize their customers more than they need to. Maybe let's see, can we hold off, only raise prices once we really know what's going on? But who knows how long that's going to take and how long we can wait in the meantime.
What about the Fed? We have reporting that shows that the search has been expanded to 3 more qualified candidates.
So this is for the Fed chair you're
Yes,
talking
the Fed
about.
chair.
Yes. So Jay Powell's term doesn't end until next May. And that's really what's been a lot of the news going on at the Fed lately of who's going to be replacing Powell. Of course, Trump has taken huge aim at Powell personally for why the Fed hasn't lowered interest rates yet. It's not just Powell, though, who, is in the camp of had been wanting to hold rates steady. Of course, we had 2 Fed governors dissent at the meeting last month, but it seems like there is more of a camp maybe now emerging that interest rates cuts are needed after seeing that weak July jobs report. So, I mean, there's just so much at the Fed, though, in terms of we had then a Fed governor also resign shortly after that jobs report. And there's going to be a temporary seat to fill in the meantime. A lot of personnel changes over there, but yes, obviously looking very closely at who's next after Powell.
Yeah, I mean, it was pretty wild just to have that. You were here with us on that Friday when all of this was happening.
It was a scary day.
Was it?
Yeah, I mean, so that was the Friday the jobs report you mean, right? So that was 8:30 in the morning, and then the crazy downward revisions, obviously really substantial. That was wild, and then it was almost 2, and I'm thinking, okay, I can probably go to the bathroom now. I can probably get lunch now, but let me come back to my desk first, just before I go heat up my lunch. And that's when he fired the BLS commissioner. So it was not in fact time to get lunch yet. And then the Kugler news, that was the Fed governor who resigned. That came out shortly after the BLS chief being fired. So yeah, it was a busy day.
So I want to start with the BLS chief being fired and what could happen to the organization and to the quality of data, because even before this happened, you had written about the quality of data here in the United States and how it's typically held up as the gold standard. Statistics Canada is really good. We know New Zealand has really good data as well, and it's kind of seen by a lot of outsiders as a competitive advantage. Is that data going to remain good here in the US?
And that's certainly the hope, and as of right now, there's no reason to think that it won't. I think where economists get nervous, though, is that this has historically been both the position of BLS commissioner as well as BLS as an institution, very nonpartisan and independent and free of politics. And they're now worried that because Trump has accused the previous commissioner of manipulating the data for political reasons, that perhaps there is now going to be, there's reason to think that there's political interference in the numbers, which again, under McIntyre's tenure, there certainly was no suspicion, and Trump's claims are completely without evidence and very much unfounded.
The person who heads up the group, though, isn't the one who actually determines the number.
No. This is an agency of about 2,000 people around the country, and a lot of these processes, don't involve the commissioner, let alone a whole lot of people, period. It is very computerized, programmed process that the data collectors are largely responsible for inputting the numbers into a system that will then, aggregate it all together across the country, across all the different categories, whether we're talking about jobs or inflation, whatever it may be, and is then analyzed and presented to the commissioner once the numbers are finalized. So the commissioner really has no part in how these reports are assembled. They see the numbers at the very end, and then we'll brief the president's team the night before a big report comes out. So that'll be happening sometime later today for when Trump's economic team is going to tell him what's in the CPI report for tomorrow.
Okay, keep that in mind ahead of tomorrow's report, and of course ahead of the August number, which we will get in September for payrolls. That is Bloomberg News economics editor Molly Smith joining us here in the Bloomberg Interactive Brokers studio.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
President Trump downplayed expectations for his upcoming meeting with Russian leader Vladimir Putin. As he seeks to end the war in Ukraine, he cast it as a feel-out meeting. He said he would confer with Ukrainian and European leaders after the sit-down. The president's effort to moderate expectations for the summit follows Zelensky ruling out Putin's demand for territory that Moscow doesn't control as a precondition for a ceasefire, with the Ukrainian leader Zelensky citing the need for constitutional approval. President Trump on Monday slammed that excuse, adding that he was, quote, a little bothered by it.
The next meeting will be with Zelensky and Putin, or Zelensky and Putin and me. I'll be there if they need, but I want to have a meeting set up between the two leaders. I was a little bothered by the fact that Zelensky was saying, well, I have to get constitutional approval. I mean, he's got approval to go into war and kill everybody, but he needs approval to do a land swap, because there'll be some land swapping going on. I know that through Russia and through conversations with everybody, to the good, for the good of Ukraine. Good stuff, not bad stuff. Also, some bad stuff for both.
That was President Trump earlier today from the briefing room. Back with us is Ed Price. He's non-resident senior fellow at New York University. He's also a former British trade official. He joins us here in the Bloomberg Businessweek studio. And I want to start with the idea of a land swap being good for the good of Ukraine. Is a land swap, that's the president's words, he said that this morning, is, in your view, a land swap with Russia the only way that this war will end?
No, it's not the only way this war will end. And by the way, land swap is a euphemism for conquest. So the fact that Well,
a swap implies that each side is giving up something, or right?
I mean, it implies that, but I'm sure that Russia is going to get more than anything Ukraine is going to be given. And by the way, the land we're talking about is Ukrainian land, back to Crimea in 2014. So the fact that the US president is on television saying he's interested in a land swap is a euphemism. He means allowing Russia to conquer parts of Ukraine.
You also argue that a weakened Russia benefits China more than a strengthened one. How does that align with the idea that Ukraine's victory should be decisive? I mean, is there a contradiction in crushing Russia while containing China?
So you've caught me out in a contradiction very skillfully, and that's a good challenge. Because yes, on the one hand, if the West fights Russia and defeats Russia on the European plane, in the long run, that's going to empower Beijing, it's going to empower China, because they won't have a competitor in Eurasia. On the other hand, if you let Russia back into the tent, as it were, and give them something in Ukraine, you've undermined Western values such that the leaders in Beijing can turn around and say, well, look, why don't we just take Taiwan, because nobody has any principles. So yes, when I make the argument that we should fight Russia and Ukraine, I then immediately contradict myself about the long run effect of that. But I think that's because, in essence, Kissinger made the biggest mistake in world history and decided to bring China into the tent before it was a democracy.
I want to go back to what you said. You answered my previous question with, it's one way the war could end. What's another way the war could end?
Well, I mean, if
and that was a land swap that you were referring to.
Yeah, so I mean, a land swap would pause the war. It wouldn't end the war, because Russia would retool, and they've moved their economy to a long-term war footing. Another way would be to beat them, right? It would be to give them the sufficient long-range weapons in 2022. I mean, we've been talking about this for years now, and I've always made the same argument, which is like, if we just give them the kit, give the Ukrainians the kit, let them finish the job, they can get Russia out of Europe. But again,
doesn't seem like there's U.S. appetite for that.
There's none, and I think we know why there was none under Biden, because he and Jake Sullivan were worried about Russian nuclear saber rattling, which I think was a mistake. We have nukes too, by the way. But under Trump, it's a bit more of a mystery. Like, why does Trump treat Putin so kindly? Why does Trump treat Putin so well? And it's not entirely clear to me, other than perhaps trying to bring Russia on board, like I say.
And you described this moment as offering Putin, quote, peer status that he hasn't earned yet. So what, in your view, would have been a more appropriate U.S. stance towards China, especially at this stage of the war?
So I think a more appropriate stance, if you're going to meet Vladimir Putin, you do it on neutral ground. You show that you're not happy about it, right? You make the right diplomatic noises that this guy is engaged in an illegal war. You don't invite him to Alaska, which, by the way, has bad juju, because if we remember, Alaska used to be Russian, and it's a bit of a flex on Putin's part to be able to get over to Alaska like that. But look, I mean, people like me would say you don't do it at all, and that we are far past the point of diplomacy.
How far past the point are we?
I don't believe that.
Look, we obviously can't go back in time, but ask that question with the question about, is there any way to salvage that?
I mean, that's another way of asking, I think, like, how far into this war are we? How long will this war continue?
Well, we thought 3.5 years ago would be 2 weeks or 1 week or 5 days.
Yes. And I guess another point would be, what is this war? Is this war a wider regional confrontation? If so, does giving Putin what he wants now something that will stop that trend or continue it? I would argue continue it. And so, but look, it's very difficult for analysts because on the one hand, we have the example of appeasement in the 1930s, and the clear lesson of that is you should actually fight the bad guys. And on the other hand, we have the very clear lesson from the Cuban Missile Crisis, and the very clear lesson of that is maybe you should talk to the Russians. So we're kind of flying in the dark here because I make one argument, which is very hawkish, and some very sensible people, including the administration, make exactly the opposite argument.
You also mentioned a, quote, American right-wing obsession with post-democratic Russia. Do you think that this ideological admiration is truly driving policy, or is it more a fringe narrative that's maybe being overstated?
It's a bit weird, right? It's difficult to tell to what extent the alt-right, so-called, in American politics is literal, and to what extent they're actually just saying things that they think will get airtime, or saying things that they think are policies, sensible policies that they need to dress up in a sort of sexier language. I tend to take people seriously when they say things, right? As I get older, I realize that kind of works as a rule of thumb. And when the alt-right says, look, we're in a late stage republic, or we want to be post-democratic, or we don't actually believe that people should vote, my ears prick and I think, okay, maybe that's true, right? I don't know why, I don't know what the benefit is to saying that unless you believe it.
Let's pause on this for a second because we're getting some breaking news. CNBC reporting is that President Trump has extended the China tariff truce for 90 days. The current deadline was set to expire tomorrow, August 12th. You just let out a little bit of a laugh. You're smiling.
I giggled. It's not professional. Taco, baby.
You see, that's what this is?
It's pathetic.
Why?
It's pathetic. I mean, the guy says, here's my red line. This is the date that something's going to happen. This is absolutely written in stone. Turns out it's written in sand. And it just makes us look silly. And if he is going to go and meet Putin on Friday in Alaska, do you think Putin's not watching that and thinking this guy has said something and then immediately caved again? I mean, it just really, it's not, I laugh because I laugh in despair, and American statecraft is all the worse for it.
But you're saying this is not good for the credibility of the United States. Perhaps the president or someone else would argue, we just need more time to get these deals done. These are complicated things. Look at the trade deals that happened with China during the first administration. Those took years. They were a phased-in approach. It makes sense that it will take more time.
Well, I mean, you're talking to a former trade official who didn't used to have wrinkles, right? I mean, they do take time.
You're looking good.
Thanks for that. That's the makeup team, Bloomberg makeup team. Yeah, but they should just say that then, shouldn't they? They should say this stuff takes a long time. They shouldn't say in 2 weeks' time, we're going to cure cancer and find unicorns. I think it demeans the United States, and he's actually put us in a lose-lose position. Either we go ahead and shoot ourselves in the foot on the economy, or we reverse course and look silly. And by the way, the economy's doing okay, right? I mean, inflation's around 2%.
We're speaking with Ed Price. He's non-resident senior fellow at New York University, also a former British trade official.
So you mentioned the meeting. What strategic upside do you see for the U.S., even symbolically, in engaging with Russia? Any headlines you're expecting or takeaways?
I expect it to be a failure because Putin is structurally determined to defeat and conquer Ukraine. And if anyone can't see that or understand that, I think they're either woefully stupid, I'll say it, or they're willfully ignorant. Now, it might be that in the very long term, there is a rational US reason strategically for bringing Russia closer to the West because of this forecast of a long-run conflict with China. So that might make some sense. But this is another very difficult position, because if we do get to the point where we rehabilitate Russia after this brutal war, we are undermining our soft power because we're saying it's okay to do that kind of thing, right?
Well, is there a risk too, Ed, that we see Russia continue to move into mainland Europe if the U.S. essentially says a land swap is a way to end this war? Yes, you can have this land because you have used military aggression against it. What's to say they wouldn't do that with Poland?
Well, so Poland is actually a very serious military power. And I think that if you attacked Poland, you might get an even worse response, an even worse bloodier nose than you did in Ukraine if you're Russia. But if it wasn't for D-Day, the Russians would be in Paris today, right? They have a structural reason not to have a functioning European Union, not to have functioning Western democratic economies anywhere near them, and they're going to continue pushing.
Hey, I just want to change subjects. We have 1 minute left with you. Yep. We're getting a question from a listener viewer right now who has a question for you about tariff theory, because you're a former trade official. The president has essentially said that academics have gotten this wrong, that economists have gotten wrong. Do you agree with that? Is it too early to tell if academics have this wrong? Just about 45 seconds.
President Trump's argument is that we neoclassical economists have it wrong because there is a bank account somewhere that's filling up with money. He is engaged in linear extrapolation. He thinks that will continue forever. It won't. At some point, demand will shift, supply will shift. You can't have revenue from tariffs in perpetuity.
There is a bank account filling up, though, with tariffs right now. Billions of dollars have flown into it.
But billions of dollars are nothing, right? I mean, compared to the trillions of dollars in debt, I mean, it's 36 point something going up and up and up. And the idea that you're going to introduce these tariffs and make money forever at the same time as saying we're trying to cut off trade is completely silly.
Ed Price, thanks for coming in. Always good to see you. Ed Price is non-resident senior fellow at NYU. He's also a former British trade official.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, we're going to start with an unusual, if not unprecedented, arrangement for two behemoth tech firms that stands to unnerve U.S. companies and Beijing alike. Nvidia and AMD have agreed to pay 15% of their revenues from Chinese AI chip sales to the U.S. government in a deal to secure export licenses. President Trump making comments about this morning from the press briefing room.
I deal with Jensen, who's a great guy, and Nvidia. The chip that we're talking about, the H20, it's an old chip. China already has it in a different form, different name, but they have it. Or they have a combination of two will make up for it and even then some. The Blackwell is super duper advanced. I wouldn't make a deal with that, although it's possible I'd make a deal, a somewhat enhanced in a negative way Blackwell. In other words, take 30% to 50% off of it. But that's the latest and the greatest in the world. Nobody has it. They won't have it for 5 years. But the H20 is obsolete. You know, it's one of those things, but it still has a market.
I want to bring in Jordan Klein, managing director for Mizuho Securities, where he specializes in the tech sector. He joins us from New York. Jordan, I want to fact check a little bit of what we heard from the president's assessment of the H20 and of Blackwell in just a minute. But first, big picture. You're positive on this development, this revenue share from Chinese sales from AMD and Nvidia. Why is that?
Yeah, well, thanks for having me. I mean, look, in a simple way, I just view something as better than nothing. I mean, I'd rather have 85% of billions of revenue than 100% of nothing. And, you know, I know what kind of investors think is a catalyst for these companies, AMD and Nvidia. And clearly it's higher growth and upward revisions. And, you know, that revenue had to come out of those forecasts and street estimates. And now it can go back in. I get it that people never like when the government's going to take a public company's money, but they're kind of doing that with tariffs already. So I think this is just another way, another form of that opens the door for, I think, a lot more revenue down the road, potentially, as NVIDIA, you know, now can, you know, sell different versions of the chip in the future, hopefully, and the government can kind of take their cut. Who knows what they're going to do with that and how they're going to position it, but I'm sure they'll have a positive take on why they're getting this revenue and what they're going to use it for.
So let's go to what the president said, and I'll read back part of it. He said the H20, he called it it's an old chip. China already has it in a different form with a different name. Is that true?
Well, they have a lot of existing H20s from when they were allowed to purchase them before the government, you know, made it illegal. I'm not sure exactly what he means that they have it in a different form or under a different name. I think most people are aware that chips were probably illegally flowing through back channels into China, or those Chinese companies were gaining access to the computing power in offshore locations. So I wouldn't say that, you know, and it is an older chip. Obviously, it's the Hopper generation. They're on Blackwell. I think the bigger question will be, will they, you know, Trump and the administration allow an upgraded version of H20, like some sort of scaled down Blackwell going forward? The other thing to remember is that I have not heard, nor do we think that the U.S. government's going to allow China to gain access to high bandwidth memory. And that's pretty important when you're training and running these massive AI models, is that you need this high performance DRAM memory, which Micron, Hynix, and Samsung make. And for all intents and purposes, that's still blocked.
Do you think, though, this creates a precedent where companies can pay to play in restricted markets like China? And how do you think moving forward this will shape enforcement?
Well, I think that's kind of what some of the media and the experts were saying when they looked at this, is that it opens the door for more AI relationships that are going to be built around how much do you want to pay the government to allow it, meaning the government is relaxing this control or restriction that was supposed to protect U.S. interests and allowing it if they can get a cut of the money. So in some form, it does seem a little, unfair, or something that maybe isn't in the best interest of the United States. But at the end of the day, these are the only relationships or agreements that have been set up thus far. And I think the U.S. is going to be very careful to signal more of these type of relationships, meaning I don't think there's just going to be a free-for-all of companies who want to start selling high-end technology into China to sign deals and say, oh, we'll just pay you for this, and then open the door. Like chip equipment companies, I don't think they're going to get approval to sell leading edge tools into China. If you see that, then all bets are off, meaning the US they're going to allow advanced production tools to go back into China, then I think they can pretty much allow anything. And until I see that, I don't think that's the case.
Is there any transparency on how the government plans to use the proceeds from this 15% share? And do you think this will be reinvested, for instance, in US tech competitiveness?
Well, I don't think the government's even given us great clarity on how they're using the global tariffs, the reciprocal tariffs, right? I mean, they're basically helping it to fund government operations and offset spending, right, and deficits. My sense is they'll come up with something that seems very palatable and acceptable to the public and investors, to say this isn't just money going into the Treasury or the Department of Commerce budget, that we're going to use this to plow back into R&D and investment into U.S. semiconductor technology. But honestly, that remains to be seen. And I think they'll keep their options open as opposed to tying that up into some specific plan right away.
Jordan, from a national security perspective, one of the concerns that the security community had essentially was, okay, well, if the U.S. doesn't give China access to this technology, then it's just going to provide an incentive for the country to invest in their own technology and do this in a way that could actually end up being better than American companies. Is that your view? And if yes, does this prevent them from doing that or slow them down at all? Does it decrease that incentive?
I think that's the key term, decreases that incentive. And I do believe that this is what Jensen Huang at Nvidia, that was his case to be made to President Trump, and why we should allow these chips to be sold into China, that this would keep them heavily reliant upon U.S. technology as opposed to going elsewhere or trying to develop it at a faster pace on their own. Nothing's going to stop China from trying to become as independent on semiconductor AI technology going forward, because they see the risk in relying heavily on the United States. But it takes a long time. You need the R&D, you need the development tools, and the United States pretty much controls a lot of that. And as a result, I think this is in our best interest for the time being, is that, we have more kind of the control or the upper hand at what they get, how fast they get it, as opposed to all of a sudden, them turning around and having better technology at a faster development pace than would have been the case if they didn't have access to this.
Jordan, got to leave it there. Thanks for jumping in this afternoon and joining us at the top of our program. That's Jordan Klein, Managing Director for Mizuho Securities. You can check out Jordan's quoted in quite a few articles on the Bloomberg terminal. You can do that also at Bloomberg.com.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
on. Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
The funky music will drive us till the dawn.
On Bloomberg Radio.
Look at that, Isabel. We are 22 minutes. No. Wow. We're 18 minutes away.
18 minutes.
Time flies when you're having fun. From the
Super fun.
close of equity trading. We've got a special guest here in the studio. Lauren Sanfilippo is here. She's senior investment strategist for Merrill and Bank of America Private Bank. She joins us here in the Bloomberg Interactive Brokers studio. I want to start with just where we are on valuations, because I think by many measures, people would argue that stocks are expensive right now. What would you say to somebody who said, I want to hold off because things are a little pricey?
I get that a lot, actually, from clients wondering, like, if this, this is related, if this rally can be sustained. Same idea here. I think what we just saw at earnings, my answer is that those Mag 7 names, the most expensive in the market, are kind of rationalizing those valuations right now. I mean, that AI story needs to come through. And it's really we're thinking about the productivity gains in the out years. And
was the AI story come through on stocks that are not the Mag 7 yet?
So I don't think we're there yet. That's why I think we're actually in the early innings, right, of this whole AI build out.
Markets seem to have shrugged off tariff headlines lately. Do you think that's complacency, or have investors rightly moved on from trade risks as the driver when it comes to market performance or underperformance?
On the tariff front, things are a lot better than they were at one point this year, right around April, right? But an effective tariff rate of 18 to 20% instead of 2%, what we came in this year, having for an effective tariff rate, is obviously an escalation. Now we have the 90-day tariff truce, whatever you want to call it, with China. So we're going to kick the can down the road once more.
Wait,
I think on this.
Which truce are you talking about?
Yeah, exactly.
I'm serious. I saw that headline cross today, and I was like, I can't keep track either. I
Right.
truly can't.
I mean, but we've worked through, to your point, Isabel, we've worked through some of these tariff deadlines. August 1st, August 7th, right? And now tomorrow with China could be 90 days out. But the market really is able to shrug it off because we're through maybe the bulk of the deals. But you're right, China's like the biggie. Still out in front here, so.
I don't see why people think that it can be done in 90 days or 180 days or 270 days when the first deal took literally like a year.
Maybe it'll just be delayed again. So given that, what kind of mitigation do you expect companies or policymakers to deploy, and will those be enough? Because to Tim's point, 90 days seems just 1.5 months. That's barely anything.
China is a big deal for a lot of companies operating here in the U.S., right? And they've kicked out some of their hiring plans, investment plans, in light of the fact of there's just too much uncertainty, right, that their business models face. So I do think that that's still going to be hanging out there. But I think that actually what we learned from earnings season is that some of that uncertainty is actually lifted.
And you flagged that early signs of consumer fatigue, especially among lower and middle income households, are showing. How concerned are you that this could spill over to broader consumption? Because we all obviously have inflation, then that's related to tariffs and just broader macroeconomic sentiment.
Yeah, good question, right? The consumer is 70% of the economy. I don't feel too concerned, because what it takes to take down the consumer is some sort of shock, right? And it's going to be a more serious shock than what we've seen. Tariffs didn't really serve as a full shock to the consumer. So yeah, in our Bank of America credit and debit card data, we have seen a little bit of an uptick here. Delinquencies, autos, right, and even on credit cards. So it's important to keep that in check. But in aggregate, it's that upper income consumer that actually drives the spending profile here in the U.S.
Claire Ballantyne on our Bloomberg News team, she writes a lot about consumers and how they're thinking about their own money. And she's got a great story today. It's one of the most read. It's about millions of Americans are ignoring their student loan bills. She says some borrowers are choosing not to pay their student loans as a matter of priorities. They're being forced to decide between paying for necessities like housing or a car versus paying for student loans. A collective $1.6 trillion in student loans are required to make payments again after 5 years of pandemic-era leniency measures, but only a third of those receiving bills are actually paying them. That's really disturbing.
It sounds like trouble when there's a housing market that's fairly unaffordable, right? In most places in the U.S. I was actually just sitting with a client who owns a bunch of dealerships, auto dealerships, and he was saying still, and remember this stat from the pandemic, more than 25% of monthly auto loans are over $1,000. I mean, that's a crazy monthly payment. So that you have to sort of consider that backdrop in terms of how expensive things have gotten for the average consumer.
So I know that you said the higher end consumer drives the economy, but what does it mean when so many normal Americans are having trouble making ends meet?
Right. That's a problem. And we look at the stat too, where I think it's more than 60% of households live paycheck to paycheck. So that's the average American. So sometimes, I know we live up in like equity land and how we're thinking about managing portfolios, but there are plenty of Americans that aren't participating in not only household appreciation, which was that wealth effect that we've seen come through really since the pandemic, but also stock allocations.
What about the outperformance gap between the US and the EU? You said that it's narrowing. So what would make you more constructive on Europe or the EM, especially given flat earnings and really just macroeconomic headwinds?
Yeah, international has been interesting this year, and we have a lot of clients asking about that sort of exposure to international. International's done well, for sure. We were waiting for that European earnings fundamental story to come through, and it hasn't, right? Unfortunately, in this most recent quarter, earnings were looking a bit flattish, depending on what industry you're looking at, but generally flattish, right? It's a story of like airlines doing pretty well, luxury didn't do so hot. So it's still a very mixed picture. So I sort of wonder, where is the next 10% leg higher? I don't know that it's Europe.
That's interesting. So where do you think it is?
Probably here in the U.S.
U.S. exceptionalism still lives on?
Well, it's not the best. I don't know if that's the best term, because I think the sort of the differential between us and the rest of the world is certainly narrowed. And same with growth differential. So there's been reason why this year has played out the way it has, right? But I do think by year end, I think there's going to be just a lot less interest in stock allocations abroad. Our fund manager survey actually looked at that. European allocations are at the highest since 2021.
Traditionally, global equities have, it hasn't been as concentrated in the U.S. as it's been over the last 10 or 12 years.
Yeah.
And some people argue there should be this reversion to the mean of a global equity outperformance. You don't see that happening? You still think the bias should be toward the U.S.? Yeah,
I think the next incremental dollar should be invested here in the U.S. That's still a lot of performance that we've seen year to date. And like I said, I don't know that they're setting themselves up for sort of repeat performance.
Lauren Sanfilippo, good to see you.
Good to see you both.
Thanks for joining us here in the Bloomberg Interactive Brokers studio. Lauren Sanfilippo is Senior Investment Strategist for Merrill and Bank of America Private Bank.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.